Good day, everyone. This is Dr. Sivaraman of iknowindices.com. Good morning. Good day, everyone. Let me display the PowerPoint presentation. Tracking the forex market together, part 1. So, you know that it is a monthly event. I am giving twin webinars every month. One during that of the Japanese or the European session, another one during that of the US session. So, today, August 27th, we will be tracking the market using the live market code page. The link for the live market code page, I'll give it in the outcome window. You can open it in a browser. I'll fix the camera over the live market code page. You will review the market currently, how exactly it is. Euro is currently trading around 1.2726, 1.2728. The low is 1.2693, the high is 1.2726. 11 pips positive net change is seen. GBP is hovering around that of 1.55, 2226 area, 1.5517 is the low, 1.5532 is the high. Nominal 3 pips negative net change is seen. So, in this live market code page, you come across the bid and the ask, and also the low and the high, and the net change. So, the low and the high are set between 2:30 and 3:30 GMT, or during the early Japanese session. They set the initial lows and the highs, and the net change reflects with regard to that of the previous day close, where exactly the current market is. So, if you look into Euro, it is 11 pips in green, that is positive territory. That means it is 11 pips higher than that of previous day close or yesterday US session close. So, yesterday US session close is around 11 pips lower than that of current level. That is what it refers to. Then you come across the GMT time. So, it is ideal to track the forex market using the GMT time because it is a 24 hours market. GMT time is ideal to track the market irrespective of using the local time. Then you find that Euro is showing a nominal positive net change, GBP is showing nominal negative net change. It is a contrarian move. Because of that, Euro GBP has gained a little bit. So you find Euro GBP is in a positive net change level. Then in the case of Japanese yen, it is showing about 25 pips positive net change, and Euro and yen are showing positive net change. That means Euro is showing USD weakening move and yen is showing USD strengthening move. This is again a contrarian move. Because of that, Euro yen is showing a positive net change of 39 pips. And you find that GBP is showing a negative net change, whereas USD is showing a positive net change. So you have nominal impact in the case of GBP yen. So GBP yen, because GBP is showing negative net change and USD is showing positive net change, we find Euro yen has gained more when compared to the GBP yen. So this is how you find that the net change will indicate which pair they are trying to handle at a given time. So this is vital for us to do the tracking the forex market during the day. So basically, I use my forecast as the primary tool. Then besides, I also use the market reading so that I'll be able to take a trading decision. Then finally, I always keep in mind that my reading can go wrong. So obviously, I use the trading strategy. So all the three are put together. If you try to do the trading, you will be able to find that consistently we are able to earn money for the market. Then in the case of USD CHF, it is hovering around that of 1.0230, 39 and 42. 1.0226 is the low, 1.0247 is the high. At 0.00 negative net change is seen. When Euro is showing 11 pips gain, CHF has not dropped much. So yesterday, you know that they dropped more when Euro was rising about 50-60 pips. Net change, CHF was dropping about 90-95 pips. And today they are just showing it other way. When euro has gained about 11 pips, CHF has not dropped. So alternative day they are handling this euro CHF and CHF. So we have to trade accordingly. It will be a patient testing game when you try to take positions in the denominator currency. And in the case of USD CAD, 1.0568, 1.0572 are the current levels. 1.0570 is the low. 1.0585 is the high. Hardly about 15 pips spread is seen, and 9 pips negative net change is seen. So when Canadian dollar is showing negative net change and Australian dollar is showing positive net change, that means both are doing USD weakening move. So you find that these currencies, commodity pairs are showing USD weakening move and Euro and GBP are showing USD weakening move, but USD Yen and USD CHF are showing now USD strengthening move. This is how they make contrarian moves in the market to start with, and later on they try to make the upward stop and then the downward stop and alternatively during different sessions of the day. So let me focus the camera over that of the initial lows and the highs set for today, so that we'll be able to understand where exactly the market is currently heading. So for today, Friday, the low and the high are intact. In the case of this is the recording done between 2:30 and 3:30 GMT, the initial lows and the initial highs for the day. All through the week, I have been noting down and giving it during the Asian session live market analysis webinar. And today, it is a tracking the forex market together webinar. Still, if you try to refer to that, we will be able to understand what they are trying to do. In the case of euro, they cut the high by 6 pips. 1.2722 was the initial low and they formed 1.2728. The low is intact. So you can understand that they want to make a rise. Then in the case of GBP, 1.5532, 1.5517 are intact. So initially they cut the high in the case of euro. Then in the case of CHF, the low is intact, the high is also intact, and currently market is trading closer to the high. Then USD Yen is 1.84.29 is the low, 84.56 is the initial high, and they cut the high, and currently it is trading around 84.70. So they wanted to make a contrarian move of rising euro and GBP as well as USD Yen. Because of that, the yen crosses will also be benefited. Then in the case of Australian dollar, 0.8846 is intact, 0.8866 was the initial high, and they breached and formed a new high, 0.8876. And in the case of Canadian dollar, 1.0570 is the low, 1.0585 is the high. Both are intact. So you can understand that they are holding Canadian dollar. Australian dollar, they have cut the high. Euro, they have cut the high. So they wanted to make the weakening move, accepting USD Yen and USD CHF. So this is how they make the contrarian move. Let me minimize the PowerPoint presentation here and focus over that of the tracking the forex market together webinar slide. So here we have to understand the market timings. I have been giving it in my trading system also. I have given the timings of the market. So now currently we are in the Japanese session 0030 to 0700. So from 5:30 to 7 GMT will be the late Japanese session. Then afterwards the gap time starts. So we will try to take a trading decisions following that. And the basic principle is you have to watch the market for 30 minutes from the start of the session in the 4 majors and 2 commodity pairs. So 0030 the session starts and up to 1 GMT we have to watch, but the webinar starts only by 5 GMT. But still we can do that, and I have shown the initial highs and the lows, and you find that euro they have cut the high and it is trading around that particular high level, but other currencies they are not cut. So if the pair is near that of the high and not cut the high during the 30 minutes of watch, you can take a sell position. Or you can try to take a buy position if the pair is near the low and not cut the low during the 30 minutes of observation. Actually, from that of the start of the Japanese session, they initially formed the low. Subsequently, they have not cut the low in the case of Euro and GBP. So obviously, market reading says that they are expected to go up. So we are in the late session, so we will try to accordingly change our strategy of taking a buy and sell trade or a sell and buy trade. Then once you try to take a position, keep always 30 pip stop or the hedging order. Why? Because any level you try to do a buy and sell trade or a sell and buy trade, keep a stop of 30 pips. That will be optimal. And if the stop is hit, don't regret and you understand that you have taken a wrong position, but you wanted to take only a limited risk and you do not want to take unlimited risk. And if you feel that the stop might be hit, then obviously don't take any position. And if you find that it is very unsafe to keep the stop at a desired level or 30 pips over the market, that means you are entering into the market out of your emotions and not out of your trading position. So in such a situation, don't take a position. In case if you take a position and try to learn the process of accepting loss and keep 30 pip stop. And also take position like one mini lot if the usable margin is less than $30,000 and if the usable margin is more than $30,000, you can go in for a standard lot trade and still one standard lot you can take and keep 30 pips hedging order or the stop until such time you close that particular position. Don't enter into another currency or don't enter into another position like averaging, etc. That leads to overtrading. Then afterwards, once the position makes profit, keep stop at entry so that you are reducing the risk to nil. That is the first step one has to take whenever the market is making slow moves or anything. And when the profit is seen, either you can grab the profit, 20-30 pips profit, if you are impulsive. And if you want to really maximize the profit, keep stop at entry. The advantage of keeping stop at entry is, suppose you are trying to take a buy position in a currency, then the currency goes up. Then afterwards, immediately you become impulsive and try to book the profit. And later on, you find it is not dropping immediately. Then what happens? You try to buy another position at the same level or slightly 5 pips lower. Then afterwards, if they drop the market, then you become jittery. So instead, if you keep stop at entry, you will be able to really judge whether they want to hit your stop back or they want to continue to gain. If they continue to gain, then you can convert it into a trailing stop and try to book the profit. And in that event, if the position is being closed with a profit, don't enter into the market immediately in an impulsive way or don't try to do that opposite trade as if you want to grab all the profit what is available in the market. That will lead you to become an addict to trading. So instead, give a forcible gap of 30 minutes and review the market, whether it is going on the upside or on the downside. Then follow the rule of 30 minutes and try to take the positions accordingly. So if they are going up further and your profit booking level is continuously making loss for 30 minutes, that means that they made a dip during that you have booked the profit, subsequently they are not dropping it. So anybody who has taken a sell position at that level, you will be incurring loss. So you try to take a buy position during the next dip. Then during the rise, you can continue to book profit. So this is how, based on your position, if you try to relate the market, you will be able to understand what that particular trader will be doing when he is holding an disadvantageous position. You are holding an advantageous position. So that way, you have to review what could be the reaction of the trader who is holding opposite of your position. Then accordingly, you will be able to adjust yourself so that you don't become either totally bullish and become trapped into that of the market sentiment. Instead, you will make a sensible decision of trading. Then once the position makes profit, you can keep 30 pips stop or 30 pips limit or 45 pips limit or 75 pips limit and use that stop as a trailing stop in a profit making position and try to maximize the profit. and the limit you can move away from that other market, calculating the different levels the market can move, and I explained it in my trading system webinar that either you can rise it up to that level of 150 pips net permissible level of that particular day as a limit level, then trail the stop so that you will be able to maximize the profit. So it is not that taking the position is important. It is very, very important for you to realize the profit when it is visible. And you have to use the trading strategy. No other method will be able to help you if you don't keep a limit or if you don't keep a stop, and your profit will not be locked. So obviously you have to see that you are able to realize the profit, and once the profit is realized, you can always look for another trade. So that is not the end of trading. So obviously don't be possessive of the positions, and that invariably make you to lose money in the market. Once you take a position and then afterwards the market is showing profit, you hold it without any limit and or with a stop at entry. Then when the market goes against you, immediately you find that a distress condition. But when it was coming at break even, you should have closed it so that you can review the market and take a buy position at a lower level. And these are all the important trading strategies one need to follow it. And when they come up to that of your buy level, obviously they are going to go below, and you will have a better level to take position. So what could be the focus for today? In this session, Euro and GBP are expected to make swing and rise move, and all through the day they are expected to make the swing and rise moves for Friday today. So we will review this particular focus during the US session, during the part 2 of tracking the forex market together webinar, and I will also give the forecast for the entire day in the blog. You can refer to that also and see what happens to that particular forecast. So I have given the market reading that they are expected, because they are not cut the low from the start, so there is a great chance it can go up. Then secondly, I also given the forecast. Then thirdly, you have to use the trading strategy. So I'll try to take a trading position. I will not just enter into the other market. Instead, I will try to keep the limit orders. So in the case of Euro, 1.29, 2693 is the low, and they cut the high, and they just come from that high to that of the initial high. So I'll try to keep a buy limit order 1.29, 2695. So 2 pips above that of the initial low, which has not been filled, and with an entry stop of 30 pips. So near that of the low, just 2 pips above, so that I'll get a definite fill when they make a small dip. I am only keeping a limit order. I am not taking the position of the market. I'll keep the limit order and watch for about 10 to 15 minutes till 5:30 GMT or 6 GMT. If they are not filling it during that, then I will try to grab it in the market. Then the European session, they are expected to make an upward gain. So during that time, I will try to book profit and show you during that of the US session. So this is an expectation, and still the expectation can go wrong. So I always have an open mind that I expect the market to go up, but in the event if it goes down, there's no point in blaming somebody. I have to protect my trade. So I keep the entry stop of 30 pips, and so that if the market goes down, it will hedge. I'll explain to you with regard to the hedging, how exactly it can be used effectively for either way trading, or it can be used simply instead of a stop, so that if it is filled, then if you are using a stop, that position will be closed. You won't be having any position. Probably you will become upset because you are incurred a loss. Whereas if we use the hedging, the position will be filled, the hedging position will be filled, your money will be blocked, 30 pips will be blocked, and you have ample time for you to close the original position with that of the stop, reviewing the market in relation to that of your holding positions. So hedging gives you the time to take a decision, and it is not an instant closure of the position. Then similarly, in the case of GBP, 1.5517 is the low. So I'll keep a buy limit order 1.5519 with an entry stop of 30 pips. Why 30 pips? Because normally when they make the swing, it comes to about 15 to 23 pips on the upside and the downside, inclusive of the spread in a currency. So to be on the safe side, 7 pips above, if we keep as a 30 pips, then the chances of the hedging get filled will be relatively lesser. And if they fill it, then you have to review how exactly the hedging is making profit or not. In the event if the position is filled, the hedging order is being filled, they filled my buy position. In case if they fill my buy position and also continuously drop and fill my hedging order and continue to drop. So let us see the possibilities. Continue to drop. What I can do, simply keep stop at entry in the hedging because the hedging is making profit. And once they finish all the drop and hitting the stops and they start coming out, then my hedging will be closed at stop at entry. And when they come up further, I'll try to keep the stop at the buy position and try to trail it up and book profit. That is one way of trading. The other way of trading, in case they have dropped it and I find that the hedging is making profit for 30 minutes, I simply close the buy position with a loss, say for example 50 pips, and my hedging will be making 20 pips already profit because the spread between this buy and the sell will be 30 pips. So my buy sell will be making 20 pips profit, and if it makes another 30 pips profit, I'll have a break even and I can close it. Okay. The third alternative, in case if they hedge and drop it, I find that new lows, they are not cut it for more than 30 minutes to 2 hours, then I try to book profit in the hedging and keep another hedging order 30 pips below in order to limit the risk. Then if it comes up, then I'll trail the hedging order upward, maintaining 30 pips with that of the market. Till such time, I am able to keep stop at entry in the buy position. And once the buy position makes profit, I book profit on the buy side also, because market can either go down or go up. On a daily basis, if you watch carefully, they make an upward stop in one session and a downward stop in another session. So obviously, we will be able to use hedging and effectively book either way the profit. So there are various other methods I'll explain later. So you find that hedging, if you use, you don't lose the position and you have time to review the positions relating to the other market moves. Then USD-CHF, they formed 1.0242 is the current level, 1.0226 is the low. So I'll keep as buy limit with an entry stop of. Why I am taking buy position? I have done the market reading and showed you that they are showing positive net change in the case of euro as well as positive net change in the case of USD-CHF. So they are expected to make the contrarian move of rising euro as well as rising CHF alternatively. So that is why I am taking a decision of taking a buy position. This is also a contrarian move. I take a buy position in euro, buy position in CHF. Then in the case of yen, they are already breached the high. So sell and buy trade I will not recommend because it's the lowest level for the season. And if you try to sell, probably you can keep stop at entry. But if you, by the time you try to book profit, they may just reverse it. And it might be a high risk trade. So I'll avoid yen. And in the case of Australian dollar, and also patient testing game, because they may not make move the whole day, they can probably make about 10-20 pips move. I do not want to block my usable margin just earning about 10 pips. Instead, I'll block it in other currencies, whereby I'll be able to earn 30-40 pips profit. So I am not sentimentally attached to any currency pair. Wherever there is a good trading opportunity, I focus on it. Then I always recommend that as a small trader focus only on Euro and GBP because they are highly volatile currencies when compared to the rest of the denominator currencies like USD CHF and USD Yen. They make one-sided moves for several days. And Australian dollar you can trade it whenever the momentum is good. Otherwise, it will give less profit when compared to that of Euro and GBP because it is a decimal currency. Then obviously it will give a less because it is less than 0.1. So obviously the moves will be much limited when compared to that of Euro and GBP. Then Canadian dollar is a currency which is a highly virulent currency. On a daily basis, it will make an upward stop and a downward stop. Whenever there is a downward stop, you try to take a buy position. Whenever there is an upward stop, you try to take a sell position. You will be able to maximize the profit. So you have to understand the behavior of each and every currency because it depends upon the volume the players make such moves. The single group of players, they make different type of moves in different currencies. Crosses also, they make it in a different way by making contrarian move or alternative move, etc. So in the case of Australian dollar, the low is 0.8846. Currently, it is trading around 8866. So I'll try to keep the buy limit order 0.8868 with an entry stop of 30 pips. Then Canadian dollar. Current level is 1.0574 and it is making a negative net change. So probably after making a downward stop and then I'll try to take position. And GBP and Euro Yen, you find that they are showing positive net change. But Euro Yen, the low is Euro Yen is low is 107.00, 107.77 is the limit, current level. So I'll try to keep a buy limit 107.04 with an entry stop of 50 pips. In the case of the crosses, it is ideal to keep 50 pips entry stop because the market is not expected to. The crosses, they are not expected to make a lesser stop and like 20-23 pips. As you see in the case of majors, because of the lesser volume, the crosses are bound to show more volatility and they could, if you keep 30 pips stop, then probably they can easily hit it. Then similarly in the case of, because Euro, GBP as well as USD Yen, they are making the contrarian move, I'll try to take then buy limit order in the case of GBP 130.80 is the low, 131.553 high. Current level. So I'll keep a buy limit 130.83 with an entry stop of 30 pips. And in the case of Euro GBP, one of the European cross, so current level is 0.8193, 0.8198 is the high, 6 pips positive net change is seen. The low is 0.8178. So it is currently trading around that of the high. They are expected to make an upward stop. We know that on the upside they make one stop and then a downside another stop. So I'll try to keep a sell limit because now you see that Euro is making a positive net change and GBP is making a negative net change. That means they wanted to initially gain a little bit of levels in the case of Euro GBP, then subsequently they are expected to drop. So above that of the high, I will keep the sell limit. So this is how the trading decisions are to be taken. They intend to make, this is more based on the market reading. So sell limit, the case of Euro GBP, is the next psychological level is 0.82, 0.8198 is the low. So probably they can hit 0.82 level. So I will, and that can do about 20 to 30 pips upward stop. And so in a conservative way, I'll try to add 25 pips to that of the high and keep a sell limit. So that will be 0.82 to 3 with an entry stop of 30 pips, sorry, 50 pips. So these are all the limit orders I have fixed, and I have not yet taken any market position. So I don't normally take market positions. I only keep sell orders to start with for the day, and or sell orders or the buy orders, and or namely the limit orders. And if they are not filled in my observation of 30 minutes or after some time, then I try to take a position of that nature. I just convert it into a market order. I try to improve on the levels, then try to take it. So this is the main important thing one needs to follow, especially when entering into that other market. We should not just like that take positions in the market without much understanding, or simply it is showing the statistical resistance level and statistical support level. If you try to take positions, probably they can make a stop and then subsequently reverse, and you might just miss that position. So the estimated levels are estimated levels. They have the limitations. So practical levels in the market are very, very important. You need to understand that. Then let the position orders be there. Let me explain to you with regard to the advantages of hedging. So hedging is used instead of stop, as I explained it. Hedging is used to continue trade when the market moves in our favor. So if the market moves in our favor, we keep stop at entry, remove the hedging order, and continue to trade with the original position. Hedging can be used to do either way trading. I explained on the downside as well as the upside, because market can only make two types of move, either on the upside or on the downside, and both ways you can make the trades. Then hedging can be used to reverse the trade when the other way going is good. So obviously I explained that in case if the market suddenly drops and I find that hedging is making continuously profit for 2 hours, I just simply cut the original position with even 70 pips loss, and 40 pips will be protected by my hedging. Then another 30 pips downward move, I will be having a break even, and if they drop further down, then I maximize the profit. So there your skill set of reading the market is very important. And in an impulsive way, if you try to cut the hedging and keep on the hedging order and things like that, then it becomes distrust trading. If it is hedged, relax and review the market for 30 minutes or even 2 hours, 3 hours or 2 days also you can do it. And then subsequently take a decision. Nothing will go wrong against you if you patiently trade in the market. If you are an impulsive person, then only the market punishes. Then hedging is used to hold the position and continue trading whenever the time permits for you to trade. So in the event of an emergency, you can just leave the trade with the hedging, or you hedge it to the market and try to attend to the other work and come back and continue the trade. And either the hedging or the original position will be making profit. If both are making loss, then you have to wait for some more time, because market cannot be in consolidation for a long time, and it will try to do the consolidation, and then subsequently you can do the trading whenever the buy side or the sell side makes the profit. Then hedging can be used to spread the risk with limited risk in each position trade. So you can also do the position trading of spreading the risk of 150 pips, buy orders at 1.27, 1.265, I mean 1.2550 and 1.24 like that. You can keep buy orders every 150 pips. Then keep in each 30 pips hedging order. And in the event of the market is against you, then the hedging will be filled. You don't worry. You just calmly wait for the turnaround to happen during the month end time. At that time, you will be able to see that only one or two positions will be making loss in the hedging. The rest of the positions will be making profit, and you can just close the loss making position and continue with the profit making position, and you will be able to participate along with the trend of the new month. So that can be done using the hedging. So it does not give unlimited risk for you, and it will only protect your position with a blocked money, and you can always release the hedging and earn more money from that of the holding position. Then hedging can be used for a breakout trade, and see yesterday there was a upward move during that of the US session. Many people would have taken a buy position after the rise above that of the high, and later on seen that the further rise was short-lived and they started dropping the market. And if they simply waited, then probably market would have shown negative or the loss in the position. Instead, they could have kept stop at entry or keep the hedging order below that of the initial high. And once the position makes profit, keep stop at entry so that you don't lose anything. In the event if they drop, then subsequently can cut the buy position when the sell is making profit and continue to book profit on the buy sell side. And that way the breakout trade can be easily managed. And in most of the trading platform, when you take the hedging position, it does not attract additional margin. Hedging with a different cross, when in US platform there is no hedging facility, then hedging with a different cross or with the other currencies might be permitted, but it will attract additional margin. So you have to see that you don't exceed your margin at any given time, so that you are able to handle it carefully. In the event if you are forced to hedge with the alternative currency, then you take half the position, so that 50% of the margin is used for taking the original position, and the 50% of the other margin is used for hedging as to limit the risk, and then you can try to trade it that way, so that there is double blocking of the margin when the position gets hedged. So let me minimize the PowerPoint presentation and take up the questions which are asked here. And focus the camera over that of the live market page. Then Shiva, can we gauge the direction of the particular pair by looking at the open interest of the pair? If yes, where to get it? No, it is not a question of open interest and closing, and they can wrongly misinterpret also. In the stock market, not normally you come across the open interest, but some of the open interest orders might be at the lowest level, about 5 to 10% below the market level. Still, it will show it is as an open interest. So don't go by those misguided information. They are not direct methods of estimating. Then grow. See, your buys or FUPs from low, do they always revert to the initial low? Most likely they reverse to that of the initial low, because the spread is very less, and since they are holding near that of the high and they are not reached to the high in many pairs excepting euro by 1 pip, so they have to make a false move before making a rise. So during that false move, always keep in mind, I explained in my trading system that they make always a false move before making their intentional move. During the false move, if you try to take the position, your position will not be hedged. Then how you estimate the quick rise spike in this based on timing? So spike is a one, which is a very quick move, and if they gain about 30 to 50 pips within 30 minutes, then another 30 minutes they will rise similar 30 to 50 pips, and the third 30 minutes they will rise another 30 to 50 pips. So that is how they make the rise. So, and in about 1.5 hours they gain about 150 pips. Then you call it as a spike. Sometimes they make the spike in one go, like an extended move. see what is the outlook for gold. Gold has made that firming up move yesterday and started correcting. Weekend it will come across the profit booking move. And because I understand that during different times it is rising time or a dropping time, but how to estimate the spike? The first rise, I explained it in my trading system. Please listen to it again. If the first rise is only 15 pips, then second 15, third 15. The first rise is 30 pips, then second 30, third 30. Up to 90 pips, they will rise. So please go through the webinars again. You do not expect me to repeat it in every webinar. That means you want the spoon feeding and you do not want to do your homework. Unless and otherwise you develop the culture of doing the studies and the learning by yourself and somebody to give you the information ready-made, then your mind is not in an ability to analyze. Then it will obviously, because of the laziness, will try to accept somebody say whatever someone says. Then if it goes wrong, it will try to blame the other person. Simple. But actually the mind has to blame itself. Instead, it will blame others. Let them grow. If USDN has broken the high, why would you take a sell position? As you mentioned, you would not recommend a sell as it is near its all-time low. Yes. So, and moreover, it has made an upward movement above that of the high, initial high, and it is sustaining there. So, probably another 2-3 hours they may hold it here, and when the traders started buying, without any further rise, they may drop it. So, if I take a sell also, I am not going to see profit. If I take a buy also, I am not going to see profit within the session. Then why to take a position, sir? Is just because of kick of it? No. I want to make money from the other market. Not I don't want to become addict in holding position and feel pressure that I am holding USDN position or USD CAD position. What greatness we have in that? Unless and otherwise we make profit out of that. And Euro GBP, it has, I think you said broke the high and you are taking a sell. Could you explain it? Yeah, in the case of yen, I told you that it is all-time low, so I do not want to do a sell and buy trade like an impulsive trader. Whereas in the case of Euro GBP, they are making a downward move trend altogether. And so I want to take a sell and buy trade. So I also study how exactly they are expected to make the moves. They went up to 0.83 and then probably from there they had dropped it to 82, 81.50. Then again they are pulling up, it drop again. And I am also reading it from that of the live market quote page. Euro is showing positive net change and GBP is showing negative net change. That means Euro GBP is expected to make an upward stopper. Hope you are able to understand that. Okay, please show that gap time slide. These timings are available in my trading system. It shows that you don't have the patience to listen to all the 10 webinars what I have given it as a my trading system. And again, no, you want a quick method of just making a note of it. And there are so many webinars I have been showing it. And again, no, you want it fresh. That means mind is so impulsive, it is not in a process of learning. Unless otherwise the mind is calm, the trading will not be successful. Let me tell you, sir, try to control your emotions. Please go through all the webinars what I have given, and FX Street has taken the great effort of recording everything and presenting it in my blog page. And it is available in the left hand side of the blog, and whenever the free time comes during the weekend, patiently listen to that, understand the concept, so that you will be able to focus on your trades rather than trying to learn the fundamentals or trying to learn the concepts during my tracking the forex market together webinars. So that now how I am taking trading decision, that should be your next level of understanding rather than asking some of the basic questions. When I expected the positions, what I had taken, the limit orders, what I had kept, and the orders are not yet been filled, you find GBP is making a dip, and probably they might fill my 55.19, and that will become a buy position. Still, I have 30 pips hedging order to limit the risk, so I am not taking unlimited risk, or I am not feeling that I am trying to buy it at a higher level because GBP came down to that of 1.5375. So why should I buy it at 1.55? No, not that sort of feel. It is near that of the low. I'm trying to take a buy. Still, I want to limit the risk by keeping the hedging order. Because the forecast says the market is expected to go up, and also the market reading says that they are not cut the low from the start of the session. CHF also, they have not filled it. AUD 88.46, 88.70 current level, still it is not filled. 131, it's not filled. So they are quite far away. They uncross it. Probably towards the late session, they could make one quick move. At that time, probably I might get the fill. Otherwise, I'll try to modify. And modify, I'll do it only for about 20, 30 pips. Not a big modification of 50 pips, 70 pips like that. Okay. So maximum of 15 or 10 pips, I'll try to modify and try to take the position. It is not filled. And now GBP is being filled. So it becomes a position. Now we can understand how patiently if you wait, you are able to get the position. There is no impulsiveness involved in trading. And nothing is going to be precious in the market. They will keep showing the level again and again. The only thing is we need to have a patience. And in the case of GBP, they cut the low 55.13 as we cut the low. 55.17 was the low. They cut the low. And we will review it. How exactly they are doing it. 55.11 is the current low. They quickly cut it by 2 pips. So as I explained that GBP, they have kept it in a negative net change and Euro still holding positive net change. You find Euro GBP has come to 0.8202. They cut the high. So I kept the order as 82.23. So this is how you have to calibrate from time to time. Okay, is my level is better? Or if not, okay, let me rise it a little bit and try to get a best fill. So it is not rigid that I kept it here, so I will wait for that, or I will not modify, and there is no rigidity. I'll just watch the market continuously and try to see how exactly they are coming with. And my hedging order in the case of GBP is 1.5409. Sorry, 54. So this is how we can estimate where exactly this, so that you can watch the current market level, whether it is filled or not. You can identify it. So I'll take this opportunity to thank FX Street for giving me this opportunity and also your participants. And again, I'll come back by 14 GMT to take up the second part of the tracking the market together with me. And that will be early US session. I'll review the trade calls, what I have given it during the Japanese session, and see the fate of those currencies, what positions, what limit orders are filled, etc. Then subsequently, I'll give the fresh trading orders for that of the weekend during the US session. Okay, see you again by 14 GMT. Thank you, everyone.